Topic introduces credit risk as the possibility that a borrower, counterparty, or issuer will fail to fulfill contractual financial obligations, resulting in financial losses for lenders or investors. Credit risk is one of the most important risks faced by financial institutions because lending and credit activities form the core of banking operations. The topic explains that credit risk arises in various financial transactions, including loans, bonds, derivatives, trade finance, and guarantees. Effective management of credit risk is essential for preserving profitability, maintaining liquidity, and ensuring institutional solvency. Poor credit risk management can lead to significant losses, reduced market confidence, and even systemic financial instability during economic downturns. The topic further examines the primary components of credit risk, including probability of default, exposure at default, and loss given default. Probability of default measures the likelihood that a borrower will fail to meet repayment obligations within a specified period. Exposure at default represents the total amount owed when default occurs, while loss given default reflects the proportion of exposure not recovered after collateral liquidation or restructuring efforts. Together, these measures provide a framework for estimating expected credit losses and determining capital requirements. Financial institutions use statistical models, historical data, and market indicators to estimate these variables and improve the accuracy of credit risk measurement and portfolio management. A key topic is the distinction between individual credit risk and portfolio credit risk. Individual credit risk focuses on the financial condition and repayment capacity of a single borrower or counterparty. Analysts evaluate financial statements, cash flows, leverage, collateral quality, and industry conditions to determine borrower strength. Portfolio credit risk, however, examines the combined risk of multiple exposures within a lending portfolio. Diversification across industries, geographic regions, and borrower types can reduce concentration risk and lower overall portfolio volatility. Financial institutions therefore manage credit risk not only at the transaction level but also through strategic portfolio construction, monitoring, and stress testing practices. Topic also focuses on creditworthiness, which refers to the ability and willingness of a borrower to meet financial obligations in full and on time. Assessing creditworthiness is a critical step in the lending and investment decision-making process because it determines whether credit should be extended and under what conditions. Financial institutions evaluate both quantitative and qualitative factors when assessing borrower quality. Quantitative analysis includes reviewing profitability, liquidity, leverage, cash flow stability, and repayment capacity. Qualitative analysis considers management competence, business strategy, competitive position, industry outlook, and governance standards. A comprehensive assessment helps institutions identify potential risks and establish appropriate pricing and lending terms. The topic also discusses the role of credit ratings and scoring systems in evaluating creditworthiness. Credit scoring models use statistical techniques and borrower data to estimate default probabilities, particularly in retail lending markets. Internal credit rating systems classify borrowers into categories based on risk characteristics and expected performance. External credit rating agencies provide independent assessments of issuers and debt instruments, helping investors compare relative credit quality across markets. These tools improve consistency and efficiency in credit evaluation while supporting portfolio management and regulatory compliance. However, institutions must recognize that ratings and scores are based on assumptions and historical data, making continuous monitoring and professional judgment essential. Finally, topics emphasize the importance of integrating credit risk analysis and creditworthiness assessment into a comprehensive risk management framework. Financial institutions must continuously monitor borrower performance, market conditions, and economic trends to identify signs of deterioration before losses become severe. Regulatory frameworks such as the Basel Accords require institutions to maintain adequate capital, implement sound credit assessment processes, and strengthen governance standards. Effective credit risk management improves lending quality, enhances profitability, and protects financial stability during adverse market conditions. By accurately assessing borrower creditworthiness and managing portfolio exposures prudently, institutions can reduce losses, improve resilience, and support sustainable long-term growth.